Welcome to the Stock Market Palantir. Today we are going to talk about VRA, Vera Broadly Inc. It's a company trading in a deeply distressed channel. It's hovering near historical lows of $1.71, yet it's sitting right up against resistance near $2.70. This makes it one of the most compelling, and I'd argue one of the most misunderstood situations in the microcap space today. The market is pricing VRI for near insolvency. We're talking a valuation around 0.2 times sales. But our central question today is whether that severely depressed valuation is truly justified, or if this deep discount represents an asymmetric, deep value opportunity, one that's protected by aggressive insider buying and some very high caliber new leadership.
And that stark divergence, between the insider conviction and the operational reality, that's precisely what makes VRA such a volatile and frankly risky proposition. I'm going to argue today that the operational data is it's too grim to be dismissed. We have fundamentally deteriorating metrics that suggest VRA is facing an existential crisis, one that's rooted in, structural consumer obsolescence. The continued decline, especially in that crucial wholesale channel, it poses a risk that I think just fundamentally outweighs any excitement over a new leadership team.
Okay, I see why you think that, but let me offer a different perspective here, what I call the asymmetric value thesis. The market is pricing this asset at approximately 0.2 times sales, and critically at something like 0.35 to 0.45 times reported book value. Now, to put that in context, these are multiples you typically see for companies on the verge of Chapter 11 or, actively liquidating. But this undervaluation is protected and I'd argue invalidated by two key strategic moves that the market has either missed or just discounted too heavily. First, let's talk about the strategic capitulation with the Pura Vida divestiture. Selling that for a mere $1 million, yes, that was painful. But what it really did was remove a significant cash-bleeding overhang. This move simplifies the whole investment case, making VRA a pure play on the core Vera Bradley brand. Second, and this is perhaps the most compelling part, is the insider conviction. Director Andrew Meslow executed a massive open market purchase, over 253,000 shares, at a weighted average price of $1.87. This isn't passive. This is aggressive buying, signaling extreme belief in the turnaround. And on top of that, the board extended its shareholder rights plan, the poison pill, until October 2026. That's a direct signal from the board itself that they believe the current price is way below its actual value.
That's a compelling argument based on market structure. I'll give you that. But I'm sorry, I can't buy that the belief of a few insiders overrides the catastrophic data we're seeing in the recent filings. Let me tell you why I think this is a structural decline, not some cyclical downturn management can just reverse.
Okay.
Look at the fiscal 2026 Q2 results. We saw a 24.6% year-over-year revenue decline. That's staggering for any company. But the real alarm bell is buried in the segment breakdown. The indirect or wholesale segment. It collapsed by 52.5%. To lose over half your shelf space in 1 year is not just poor performance, it's a systemic destocking event. That means a persistent loss of shelf space, visibility, and volume that is incredibly hard, if not impossible, to get back. And on top of that, this has triggered a liquidity crisis. Cash fell to just $15.2 million, forcing VRA to shift from a net cash position to a net debt position by borrowing $10 million. And they're using that borrowed money to fund operating losses. The company swung to an operating loss of $4.7 million for the quarter. This just shows the danger of high operating leverage. The fixed costs eat you alive once sales drop below a certain point.
Okay, I acknowledge the severity of those metrics, especially that 52.5% collapse in wholesale. It's a brutal number. But let's discuss that in the context of the executive overhaul, because that's where the solution, the tapestry DNA, as I call it, comes into play. I'd argue this overhaul fundamentally mitigates the very execution risk you're worried about. The company has imported world-class talent. We're talking about Executive Chairman Ian Bickley. This is the guy who scaled Coach International sales from under $20 million to over $2 billion. That's not just scaling, that's transformation. And the CFO, Martin Lading, he brings discipline from Coach and hype cycle management from his time at Supreme. This is exactly the caliber of leadership you need to execute something like Project Restoration.
I acknowledge the resumes are impressive. I do. They are undeniably the right people for the job, if the job is even possible. But high-caliber management doesn't guarantee success against these kinds of structural headwinds, against a profound loss of brand relevance. The problem isn't just the wholesalers refusing to stock the product, it's that the customer is refusing to buy it.
I don't know if that's entirely fair.
The decline in their own direct-to-consumer comparable sales was still a negative 17.3%. That tells me the brand is losing its core, loyal customer base. Project Restoration rests on 4 pillars: consumer, brand, product, channel, and each one represents immense execution risk. They're trying to pivot from a boomer-centric brand to, what do they call it, heritage chic. That requires resonating with younger demographics who've already moved on. I mean, we can't just assume that Coach's playbook from the 2000s is going to work here.
See, the premise that VRA is suffering from consumer obsolescence is debatable, and the new management is directly challenging that. They're doing it through strategic brand validation. Look at the high visibility collaborations, things the old team just couldn't pull off. The Anthropology Holiday Collection or the partnership with the Rockets. This isn't just marketing fluff. Placing product in Anthropology strategically validates VRA as heritage chic, and it starts to reopen those wholesale doors. And what's more, the financial bridge to recovery is credible. They've targeted $20 million in annualized cost reductions starting in fiscal 2026. That provides a tangible, measurable path back to profitability. Analysts are actually estimating a return to a positive 5 cents EPS by fiscal 2027 because of it.
But that bridge is built on very shaky ground, and that leads us right back to the question of valuation. I have to challenge the validity of that 0.4 times price-to-book multiple you cited as a safety net. In a fashion turnaround defined by steep revenue decline and, as the company admitted, increased promotions, that old inventory used to calculate the book value it's toxic. It's impaired, it has to be liquidated at massive markdowns just to generate cash. That process erodes brand equity and, more importantly, it means large future inventory write-downs are coming. And those write-downs directly reduce shareholder equity. That means the book value on the balance sheet right now is potentially a complete mirage.
That's an interesting point on inventory quality, though. I would frame it differently. I'd say the low PB ratio just indicates the market has already factored in a lot of that liquidation risk. The downside is already priced in. The real catalyst here, which complements the management overhaul, may not be fundamental yet. It's technical. Short interest is elevated, somewhere between 7.4% and 10.2% of the float. More critically, the days to cover is extremely high, between 5.5 and almost 10 days. For a stock this illiquid, that massive short position, combined with the board's explicit signaling with the poison pill, it creates a classic coiled spring dynamic. If the company achieves even marginal stabilization next quarter, a massive short squeeze is technically primed to occur. And that gives the team the time and the stock stability they need. I appreciate the technical setup, I do, but let's be clear. Technical trading factors cannot fix a 52.5% collapse in indirect sales. You can squeeze the shorts, but you cannot force major retailers to place new, substantial orders. It just doesn't work that way. I appreciate the technical setup, I do, but let's be clear. This massive loss of wholesale volume forces Vera Bradley to become a much smaller, more niche, direct-to-consumer player. It fundamentally changes the company's economic model and limits its long-term revenue potential, regardless of market microstructure.
So for me, focusing on the short interest it's a distraction from the core existential danger, which is we still haven't found the revenue floor. Okay, so let's talk about that. Let's talk about the company's financial stability. I acknowledge the shift to $10 million in debt. However, total liquidity, which includes their revolving credit facility, remains strong at roughly $86 million. That is sufficient capital to fund this turnaround plan through fiscal 2026, assuming the cost cuts are executed. And while they suspended guidance, that was mostly because of the executive transition, not necessarily terminal financial distress. Analysts still have a consensus buy rating with a $4 price target. They're anticipating that the cost cuts will yield profitability by fiscal 2027, even with a smaller revenue base.
But I'm not convinced, because that $10 million in debt is being used to fund operating losses. That is a major, major red flag for equity holders. That high operating leverage means they are burning cash and fast. And now you're introducing covenant risk. If revenue continues to collapse, or if they have to do a massive inventory write-down, VRA risks breaching the covenants with their lenders. And at that point, the lenders, not the shareholders, are in control. For any risk-averse capital, VRA is simply, it's uninvestable until we get clarity. That upcoming earnings date, December 10, 2025, that's the critical event. Until then, the risk just keeps escalating.
So to summarize my position, VRA is undeniably a special situation asset where the market has, I believe, over-discounted the risks. The combination of world-class operational talent, that tapestry DNA, and substantial insider buying at these low levels suggests the intrinsic value is significantly higher than where it's trading. For an investor focused on distressed, deep value, this setup presents a highly compelling asymmetric risk-reward profile.
And my summary stands firmly on the fundamentals. While I respect the capabilities of the new management, the underlying risks, that 50+% collapse in wholesale, the inventory toxicity, and the rapid erosion of cash that's now being funded by debt are existential. The recovery thesis hinges entirely on flawless execution of Project Restoration, which is an immense, difficult bet to make until we see concrete evidence of sales stabilization. Until those metrics improve, the structural decline thesis remains the stronger argument for me.
And that divergence between the technical factors like short interest and the poison pill and the operational data like the channel collapse, it makes VRA a true binary investment outcome. It forces you to weigh the conviction of insiders and management against very clear signs of structural decline. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel